webinar series talking about the Federal Open Market Committee pivot that took place yesterday, and we're going to talk a bit about the economy. So thank you for joining us. A couple of housekeeping things. As most of you know, we do record our webinars, and they'll also be available on our website and also on our YouTube channel. You can always reach out to your MFA advisor, who will happily share that with you and give you a copy of the presentation. With that, I'm Charlie McQueen, President of McQueen Financial Advisors. I'm thrilled to be here today with everyone. And most importantly, my co-presenter, Craig Cecilia, Chief Investment Officer, Managing Director. Craig, thank you for joining me today.
You're welcome, Charlie. Good day to everybody, and thanks for joining us. Looking forward to spending the next hour with you.
Yeah, we're definitely excited. A lot of things happening in the investment world, and Craig, your expertise is extremely welcome and very helpful in these unique and changing times. I'm a step ahead. I covered the administration. We are recording the webinar, but thank you all for joining us. And again, we are YouTube stars. If there's a like button, push it. That'd be really nice. Appreciate that. So kicking off and getting right into stuff today, it's the pivot. This is something we haven't seen for quite some time. As the writings we've been doing for the past couple of weeks or month, we've been talking about this being a really big Fed meeting. And the reason being, pivots don't happen that often. And when they happen, it's something important as we think about our situation being a financial institution, that we think about how we need to change and how we're going to change our decisioning from loan rates to deposit rates to investment activities and all of that. So it's really important to look and see what's changed and why. And if we think about the pivot and what happens, the pivots don't happen that often. So this is a big thing. Craig, we've had three circles on the page here, and the last one doesn't quite have that drop. It just happened yesterday. We'll have that updated, but these are the most recent three pivots we've had.
Yeah, and I really like to see when looking at this, if you're just focusing on those three pivots, what happens after the pivot to the right is what we're going to talk a little bit about. What's leading up to it, what comes out, what's the consequences, and more importantly, like you said, what are we going to expect over the next 12 months, 18 months, right?
Right. And you can see here, obviously, as Craig alluded to, in 2007, that was the breaking of the financial bubble, we'll call it the everything bubble, the housing bubble. And we saw rates obviously come down to effectively zero. Then in 2018-19, that was actually the Fed was doing something which I think Craig's going to talk about today to foreshadow maybe a normalization of interest rates. That's what they were on the path of. They were raising rates off of zero, and then COVID hit. Then now we go into the inflation from the free money drop and see what comes next from here. But it's definitely interesting. Remember that normalization. I think that's something we're going to talk a bit about today. All right, topics. Just to get everyone ready, we're going to talk about inflation, unemployment, which amazingly, I think that's the Fed's dual mandate, Greg, if I remember correctly.
Well, yep, we got one and then we got two, employment and inflation. But you got to recall, everything's with a grain of salt on whether it's where you want it to be or where it's going to, right? The direction of where we're going to is exactly what the Fed has been wanting to, and hence that's why they did a little bit of a pivot.
Okay, I was thinking salt over the shoulder with the tequila shot, but okay, that's fine. We go for that. I love that. But no, it is important to take it that way. We do go to housing and stock prices and wealth creation and the consumer health we'll talk about. We've got a good discussion then and some projections for everyone. So to kick it off, we did send out some information. Our projections with the Fed was going to lower the federal funds rate by 25 basis points. And I was surprised by the 50 basis points, as I think maybe many were. But the Fed did in reality lower the Fed funds rate by 50 basis points, and the top end went down from 5.50 to 5%. Does this mean that there's like a massive recession brewing in the distance and something that Mr. Powell doesn't want to talk about? Is there a hidden problem out there, Craig?
I sure hope not, but I do think that they've got a lot of confidence by moving that 50 basis points, and their feeling is that the economy it can absorb the lower rates and absorb the extra activity that's going to maybe come along with that lower rate environment when a little bit of an easing on rates. We do have some concerns as well as they do, but they think the risk outweighs the benefit to lower rates. And so that's why they're going down. I don't see a major recession around the corner, to be honest with you. I love the trends. I believe a soft landing we're experiencing, and they're trying to keep us in that sweet spot.
So you're talking about the 2005 was the last time they did the soft landing, which was arguably a soft landing. I think what they achieved was actually having rates come up without a big level of unemployment. And that's what we refer to as a soft landing. And very infrequently has that happened, only once as far as we can tell. But I think your comment there is good. I think the Fed came out yesterday, as you said a moment ago, less concern on inflation, more focus on unemployment. I think
Yeah.
that's the shift, right?
Yeah, well said. Just ask when you're talking to somebody that says, "What are you talking about?" We're not experiencing a soft landing. Ask them to define a
Yeah.
soft landing, and you'll find they're going to be saying what a soft landing is and what we're experiencing.
Well, and one of the things that's to me, I think about that is you ask, you define is important. And later in slides, we're going to talk about the K-shaped uh, environment that we're in, the K-shaped economic activity, and the haves and have-nots. And we'll talk about those that have houses and those that don't have houses and are paying rent. And really, it's a very different economic environment based off of the position in life you're in right now. So we'll spend some time on that. But hopping right into the Fed's dual mandate, Craig, last that you told me is that the Fed wanted a 2% rate of inflation. If I look at this chart here, and I can look back over forever and ever. To me, it's I got my laser pointer here. It's been this 2% rate of inflation basically until this explosion. How come the Fed's lowering rates and we're still at a 3% rate of inflation right now? It doesn't make a lot of sense to me intuitively.
No, I agree with you, and because we have had the inflation rate coming down, not approaching 2%. We'll call it arguably on the 2.5%, just depending on which index you look at, and slowly coming down. But they're really focused in on what's happening in the retail side and the employment section. They're worried at that rate of increase, which we'll see in a little bit. That mandate is more important to them right now, and they wanted to offset that. And they feel that the inflation will kind of stay in that area that they're at right now. It's really confusing. You fix one, it's going to hurt the other a little bit. So I think that's
Yeah.
why you and I are a little surprised yesterday. They went with a full 50 basis points. Oh, and there's your slide. Well,
Yeah.
great segue. Oh my, you're good. I can't wait to talk about the K car that I used to drive. But um,
Oh,
yeah,
Chrysler K car. I love that. You're bringing back my brother had one of those. That was funny. Love it.
yeah. So inflation at that you have here, you can see that is coming down, and we have that little tick up, right, on there. And this is the CPI. Is that correct? The
Yes, it
core
is CPI.
CPI.
Yep.
Yeah, so it's been coming down. They feel it might trail down. And then we also look at, those are their two mandates, but they don't alienate all other data points. It's,
Right.
data dependent. And I love that. It never is not data dependent. And looking at some other things like delinquencies on that consumer, it's starting to get a little ugly in certain asset classes.
Oh, we're going to cover delinquencies here in a second, but you're absolutely right. It is getting different. But I think inflation is interesting too. Um, I love political time of the year, and I got to get my tinfoil hat on and talk about, is the Fed political or not political? But the one thing I'll say here is energy prices have been our savior. All items, including excluding energy is up 3.32, 3.3. It's a big number for the Fed to lower rates, and energy has been our saving grace. And so there's two things. One, we're the largest exporter of oil in the world now, or largest driller of oil in the world now, which is truly amazing. I wish our elected officials would actually encourage and push this versus attack it every day, such as natural gas, some of the tough stuff that's happening in the political side there. But this is huge for us. But also energy does indicate less utilization, supply and demand, which could mean a slowing of the economy. So that is something that might be scaring them also here. What are your thoughts on that?
Well, I think it's an actual fair point. And I haven't looked at rig count and actual barrel count and stuff, but our economy, it can be self-sufficient in the whole energy world, right? Plain and
Yeah.
simple. And I think that that is extremely volatile area. And I do believe that uh, the use and consumption of that energy has been a little bit volatile in the manufacturing and also in the retail side as they're trying to do the whole push for green energy. right?
Yep.
So the main majority of this is from not from is from oil, right?
It's
This
drilling oil, the bigger and more oil and more natural gas, keeping those prices low, which, man, that's so important.
yeah.
But speaking of not low, is food prices. One of the things that we're seeing is continued inflation in food prices. Food prices are up now 30%, 25 to 30% over the past 3 years. This is definitely taking a bite out of, especially people at the lower end of the economic earnings side. That's taking a bigger bite out of their monthly budget, to put a bad pun out there. You see this changing? We're going to get this come back down because the Fed raised or lowered rates. We're going to see the cost of food prices come down.
I don't think so, to be honest with you. I really don't. And I do want to add a caveat here we're talking food prices at the grocery store.
Correct.
And if you really take a look also at eating out, I don't think we have eating out as a chart, so I don't
No, we
want to
don't.
ruin a future slide, which I've done twice already.
That's entertaining. Come on now.
Is it's even more inflation in that world as well. So this it's kind of a driver of having people stay at home and shopping at those markets, which I think it's not going to alleviate. We'll still have inflation, but the overall set of the base cost of things are not going to come down all that much, regardless of the Fed moving rates down.
Yeah, I agree with that. And, getting more granular here, and this is about going out to eat at a restaurant, you start to look at things that here are inflationary, and insurance. And we've had homeowners insurance has been high on this list. It's not real high on this list right now, but homeowners insurance is skyrocketing. Auto insurance is up 16%. Rent, it says here only 5 and housing only 4. I don't believe either of those numbers. Are much higher than that, everything I see. But we go down this list, it's really interesting. The things that are deflationary or disinflationary at the very bottom are really things that we don't use much except for gasoline, but used vehicles, rental cars, furniture. Well, you're not buying furniture and appliances if you're not moving houses. And we're going to get to something about a low level of housing transactions. But the biggest savior for people is gasoline today. But there's a lot of other things that really are pushing up the cost of inflation. And groceries here says 0.9%. So I don't buy that one, but definitely seeing some numbers here, which again, it's getting better. I think the term and what you wanted to use and the point making from all this is that inflation it's obviously things are still going up in prices, but at a slower change.
Yeah. And when you ask, well, what is one of those catalysts for the Fed lowering rates with all this other data out there? This is one of them, right? It's not going
Yeah,
away. It's stressing the majority of our population, the consumer, and the consumer makes up a huge percentage of our GDP. So
yeah.
they're really trying to help.
Yep, consumer is 70% of GDP. So, speaking of the consumer, going to unemployment now, the unemployment rate, and there's this magical line right here at the bottom that says 5%, right next to my shiny little light there. That's the magic number. When I grew up as a kid, they always said if 5% of the workforce is unemployed, that's full employment. What are your thoughts? We're still below full employment at United States at 4.2. Is that why we should cut rates? Because we need to help grow employment?
Oh, no. And instead of using what I've used as a sweet spot, I'm gonna use the clown's mouth, right? You want to shoot into the clown's mouth with the water gun to blow the balloon up, right? I love the 5% level, and we're slowly trending to it, though. The problem is the last 4 months in a row, we have trended towards that.
Yeah,
And
there's your trend right there, going up.
exactly, exactly. And so they're fearful that, I think somebody used to say, maybe you, the trend is your friend,
Trend is
right?
your friend. You're only wrong once.
You're only wrong once. And so even though we did have that little tick down, the overall trend is going up. And so they want to be a little more preemptive so they don't get hurt. They hear, hey, they were too late type thing.
So the Shazam rule, Shazaz rule, what's that one again? If inflation goes up by like 0.5%, we're doomed and the whole world's falling apart. Is that going to happen here? Or is that not going to happen?
You've been watching cartoons with your daughter too long. Shazam.
Absolutely. Shazam.
The
Roadrunner's
Som
the
rule.
best. Yeah.
Yeah, Som rule. Claudia Som, brilliant lady, by the way.
Mhm.
And that's what a lot of people were kind of looking at, that it's predicted 100% of recessions when this
Right.
happens. And I personally think we should just throw the Som rule out this time because there are a lot of different things going on in our economy. One thing I like to look at is our prime age workers from 25 to 54. That's the category. I don't know why 54, but it is. And that number of employees or people employed in that group has not gone down, even though unemployment's going up. And we're at historical highs for participation rate there as well in that prime age. So there's a lot of unemployment going up, but it looks different than previously triggered by the SOM rule.
And then she actually herself said that doesn't is not applicable this time, I believe, if I read the news correctly. But with that, I love this. Every time you say jolts, all I can think of is Jolt Cola. As a
Oh,
kid, I grew up with this, and could you imagine having to like, give it to my daughter to take to school? How would they respond? All the sugar and twice the caffeine. That's how they sold it. I mean, what a great stuff. But so besides being a caffeinated drink back from a long time ago, it's probably illegal now. Job openings. What's going on here?
well, we got a ski slope. It's coming down. Jobs are being filled, and we're not having as many people moving around, meaning quitting their jobs. That is an indicator that people are not necessarily as confident in what's happening in the world. The other thing on job openings that I look at is what jobs are actually opening, and our business is not actually hiring or looking to expand as much as well. So this isn't necessarily a good thing that it's coming down, but look at that long-term trend. Right. So even though it is coming down and it could be a sign or a warning that people aren't expanding their businesses and looking for new people, we're unusually high compared to the long-term average of how high of where we're at still.
Yeah, it's really, this is not a recessionary number right now, is another way to say it. This is a very strong economic number, and it's making things look good. And if we look back to the far left-hand side of this chart, 2009, again, big recession, we were down to 2 million open jobs. So a lot of room here. It shows a couple different things, but very interesting spot. But it is coming down, and this goes back to that soft landing activity that you keep mentioning, is they're trying to manage this on the way down. But one of the things that I really struggle with is how in the world do you start lowering interest rates when you have housing prices at record levels? And we already covered food prices at record levels. We always covered, well, I think we're hit rent here in a minute, record levels. But I feel for people trying to buy homes today. They're just absolutely unaffordable across the board. I don't want the housing market to break because I own a house. But if I didn't own a house, I'd want the housing market to break so I could buy one here. Definitely unique situation.
Yeah, of course. One of the things that we've watched and witnessed is the appreciation of the home builder stocks, right? If you
Right.
go back for a few years, they've just been exploding. And I'm going to be devil's advocate because I agree with you. Lowering rates is really going to cause this to be a little bit bigger of an issue. But because it becomes an issue, I think it will be a catalyst for more home builders to actually enter into the market and help develop and maybe solve some of our inventory problems. Because, outside of we can discuss the affordability of the actual new home being built, right? That inflation's really killed it. But I think it might help bring in a little bit lot more housing starts.
Yeah, so supply and demand is like what we're going back to, that really basic thing. And we do have
Mhm.
about 3 million new people born in this country every year. We have some big immigration numbers the last few years, which is definitely not helping the housing situation at all. So really the biggest solution here is either destroy the economy or have more homes built.
Right. And well, lowering rates is not going to destroy the economy. So
Yeah,
let's
they're leaning towards build more homes. All right, that makes
build more
logical sense
homes.
to me. I think
Yeah.
this actually highlights your point really well, Craig. Here we have the two red circles, and this is back in 2009. The blue line is existing home sales. It's off the right-hand side of the chart. We were at 4 million. We're now below 4 million. So we're at a level of home sales lower than where we were right when the economy completely fell apart. So very low level, which is then the supply and demand, not enough homes for sale, a lot of people wanting to buy, and that continues that process. New home sales are still painfully low. They're off the left-hand side of the chart, around 668,000 an annualized basis. Just to remember, if this chart went back another couple of years, we'd be up to the million to 2 million range of new
Right.
homes. So it is clearly a supply and demand problem that needs some help. What that's leading to, which is really interesting here, and feel free to go back and make comments there, but the rent issue, because homes are so expensive, rent has really gone up, and we're now up to about $2,100 for a one-bedroom apartment on average. We had a 15% increase of rents just 1 year, year and a half, 2 years ago. Crazy modification of rent prices today in the housing world right now.
Yeah. One of the things that they have been fixing is multi-family units being built and brought onto the market, which we've had some escalation of those rents, and we're expecting them to slightly moderate because of units supplied in multifamily, which a lot of investors and builders and REITs have been focused in on. But the single family is not going to help the problem. So you got one helping, one hurting, and it's once again hitting the pocketbooks of every consumer on this. That's looking into the market to either buy or rent.
And I do think one of the things here we will see, at least hopefully, rent stop going up because of the volume. There is a lot of volume coming online in a lot of cities here in the next couple of years, and I do think that's going to really probably oversupply would be my expectation, which will then help the rent side of things. Which then, in a lot of ways, if you go back to the alternative between renting and buying, maybe that'll help us with some prices on the housing market also. All right, so we've got home prices at record highs, we've got food prices at record highs, and we've got a stock market at record highs again. So we should definitely be lowering interest rates to juice this economy, right?
Oh yeah, today. Yeah, right. Just needs to be juiced more. Yeah, I love
Yeah,
that. But yeah, even today, we and all indices, we're hitting record highs again. The market loves that the Fed lowered rates. They think it's good for businesses and the valuations and the growth of them. So it's fascinating to me.
yeah, definitely. The record high stock prices, it happens on a regular basis. Record highs is we've been consistently in an uptrend for quite some time. But it is interesting. Wealth is growing for those that have stocks and those of homes. And one of the things see here, it's really amazing. I've got this great picture from Yahoo Finance. Household wealth hits a record 163.8 trillion in quarter two of 2024. Amazing increase of home prices. Now we are going back to like 1950 on the left-hand side, but just even looking from 2010, you can see the housing bubble right there. But then what's happened with the wealth from there up has just been an incredible run.
Yeah, and that's kind of I love it that you're bringing this out in these slides, Charlie, is the wealth and the equity, the wealth in the house, and it's just as a new variable that the Fed has to deal with. And I think you're going to talk a little bit about it in a little while.
Yeah, I think Craig, you keep reminding me on a regular basis that the money given to individuals from the government through the COVID programs uh, really was a game changer for economic monetary policy. And looking at where we are today, that money, it's very hard to predict. It's that what has happened in the history will happen now because of those changes in the amount of money in the system. Again, not fair. We still have that K-shaped economy, which we'll talk more about. But really, this leads to the consumer. And the consumer, we've got some positives and we have some negatives going on right now in the consumer. And really important to think about at your individual financial institution. How are your consumers, your customers, your members, how are they doing in this environment and how are they going to fare? And so one of the things that really I thought would be a good way to kick off the health of the consumer, a good friend of mine, Tom, put this graph together and presented it at a conference the other day. So I stole it, but I did put his name on the bottom, so I feel better. Um, but looking at this, 50% of consumer interest expense is non-mortgage interest now at a record high. So if you look at that, there are two things at play here. One, that low interest rate environment we went into with the 3% mortgages has allowed me to have free cash flow to buy other things, which really propelled the economy. But now it appears to be that maybe people are getting pretty high on their non-mortgage interest expense. Maybe they can't handle it that much anymore. What are your thoughts on that, Greg?
Well, outside of it being a big concern, we're going to cover an asset class or two later, but just like the government's debt, the consumer has been leveraging their household. And it just kills because and that interest doesn't go away, right? Especially when you have that much of interest expense, and it's not going to be healthy for the consumer that's been leveraging a house. It's not strategic. It's more of, hey, I need and want, and I'm going to finance it. It's just not good for our economy. So, and that could be one of those indicators of what the Fed is seeing as well. One of those other variables saying, hey, there's something around the corner. We better prepare for it. Let's lower some rates a little bit to make it a little easier.
Yeah, I think it's a great way of looking at it because I do think as we look at, you think about when rent and home prices and homes being so unaffordable, people's monthly paycheck isn't making it as far as it used to, with these higher expenses, which is going to slow down their spending in other places. And this is saying the same thing. People's expenses and other interest things are going to cause them to not be able to spend money in different areas. And again, the consumer is 70% of our economy. This is going to make it tough to grow loans. One of the things I've been hearing from clients over and over for the past couple of months is we're not getting the loan volume we expected. And I think this is a really good indicator that we're going to have a difficult, probably couple years now of loan growth, given the position where most consumers are. And talking of loan growth, just to take a jump back to savings, and then of course we're going to go back to loans again, because I probably put these slides in the wrong order. But outside of that, hopping to the savings rate, this reminds me of although a little bit of a recessionary level. So I look back at the savings rate back here in 2008, before we got really low there also, where we are today. What are your thoughts on that, Greg?
All right, so if you look at that last recession that's on our chart, it was really low, and then through the recession, you saw that savings rate rise, right? You can see that little ramp up there, and that's very typical, and it totally makes sense because when things are going great, people are confident, feeling good about the economy, spending money, leveraging their balance sheet, their household balance sheet. Their
Yep.
savings are down low. They're like, I do not need a rating excuse me, a rainy day fund. What do I need that for? Easy
Yep.
for me to say, right?
Yep.
But then recession hits, and then the saving rate skyrocketing. So, is it a leading indicator for a recession? Very much possible, but this savings rate isn't very much an indicator that people are feeling confident, or they just can't afford to save right now. So that's
Right.
the other variable, right? They're spending a lot, can't afford. It could be inflation, could they're buying a lot.
Yeah, it's definitely interesting to me because that makes perfect logic sense. And then I go look at the dollar amount of assets in money market funds, and I just completely spin myself in my head. And I go back, that's the COVID money. It's the COVID money.
Yeah.
So interesting. Well, with that, going back to where we're on loans, credit cards are a concern that keeps hitting the news every day. We just hit a new high, $1.14 trillion of credit card debt. Also record high interest rates on credit cards right now. We're seeing, it might not be record highs going back to the 80s, but at least since the 80s, record high interest rates. Um, it looks like this really grew fast in the last couple of years here. I'm really surprised by the growth. How about you?
Yeah, it's a warning sign. Just think about all that interest income somebody's going to be collecting and all the balance sheet or
I
income statements.
love that. We should be issuing more credit cards. I love it.
Well, yeah, with some kind of personal guarantees or collateral, maybe collateralized credit card.
That's it. We got a whole new product line we're coming up with. I love it. Uh, but this is another thing that's going to show the consumer is going to most likely be stressed and have a hard time with debt payments and slowing of the economy again, which then goes right along the line of what you've been saying about the Fed preemptively starting to cut rates. And this might come to a reckoning someday with credit cards, because if we do look at this, we are seeing credit card delinquency up, as we can see here on the right hand side of the chart. But if we look back, we're not what I'd say in a bad spot. I mean, I'm actually surprised it's not higher given the balances, in my opinion.
Yeah, you'll notice that for a lot of our historical data we're looking at today, we're had such a change over the last 12 months on the trends, which are very much a red flag. But you'll see that we're getting back to normalcy, normal rates, normal delinquencies, a lot of normal things. And this is one of them. And for credit cards, it's exploding the delinquencies. And we had that really low, long rate environment that there were delinquencies didn't exist, right?
And that's that 10 to 20 time frame there. And you can look right in here. I mean, just we had that was abnormally low, and we're going to get back eventually up this. And I mean, this is why 20% interest is charged on credit cards, because you're going to have a 4% type loss rate. So it's logical, but it is a big change.
Yeah.
Well, one of the areas that I keep getting asked about is commercial real estate and commercial real estate foreclosures and bankruptcies. You hear the stories that pop up. People are talking about all the buildings selling in San Francisco and Chicago for pennies on the dollar, and but we are seeing commercial foreclosures of buildings rise quite a bit. I don't think this should be a surprise to anyone because of the work from home activities and the change of some people desiring to be in more rural areas than cities at the moment. But I kind of expected this number to be worse based off of what's happened in the last couple of years.
Yeah, and I think it drills down to all of the understanding what the headline risk and what media has been really, really talking about is that office space. Another one that's not doing so great is retail, to be honest with you. But there is some good commercial real estate out there still, right? And that's where it doesn't look as bad as we would think because of all that negative media out there. Stuff that's doing okay is still CNI and still multifamily is still doing well in the commercial space. So it really depends on what sector the lender or the securitization, the conduits are actually invested in, which makes it bad or good, to be honest with you.
Yeah, definitely some changes happening in value resets. And this is something that lower interest rates will actually help this area with the Fed lowering rates a little bit. And it's still going a long ways to go, but it's heading there. Well, speaking of failures of failing business loans and foreclosures, but we get into bankruptcies. Um, Read an article the other day that talked about how bankruptcies were exploding, and I went back to try to get more and more data. And this chart's really good looking to me because it made sense. I wish I'd get this back to 2020 and or 2000 even. But we can see here that business bankruptcies are up around 19,000, non-business 400 plus thousand for a total of 450. But we have to look back. We really bottomed out in 2022, and 2021 was still low at 400,000, but we go back to 2019 to more of a normalized rate. It's a $700,000 number or 700,000 number, not $700,000. So it's definitely still low here. I think so. This does show an indication of the economy still is fairly healthy when looking at it from a bankruptcy standpoint. You feel the same way?
I do. I do. And I think that's one of the reasons that the Fed was lowering rates and not going 100 basis points right now, right? Just
Yeah.
slowly tweaking it down, saying, all right, we're seeing some trends. Let's do something just to hopefully stop and help it go sideways. So,
Yeah.
but it's still looking okay to me.
Yeah, so I think at this point we've done a good job of showing some data points and graphs and talking through some of the major things, which is going to be, if you think about this, we've covered unemployment and inflation and housing and the consumer. That's really what we're looking for and thinking about. But from here, I want to get into a discussion to hear some of your thoughts on where we are and what's coming. And I'm going to share some of mine, and then we're going to have a talk about some of the products and products for all of our balance sheets and income statements, and then give some projections here as we roll forward. So with that, Craig, love to have you maybe explain some of these thoughts here. This long stretch of bullet points I kind of jammed on this page for us.
Absolutely. Let me take a drink of water while I do this. I'm going to start and end with the same statement, and you can ridicule me afterwards, and I'm okay with that.
Okay.
Is yeah, is we're experiencing a soft landing, right? And I want to talk a little bit of the positives that are causing that and some negatives that are existing and acknowledge them, right? Because we got some deterioration. The GDP, right? So done a lot of research on this, been really watching it, and our GDP is doing well. If you strip out the last half of 23, which was absolutely phenomenal, absolutely, four handles, doing really well. Our long-term average is right around a 315 for the last 75 years, and that takes into account extreme growth and extreme recession periods. We're right now in that range right now. We're doing well. It's clipping along. I think we're doing well, and we're actually in the process of bringing inflation down. Fabulous. Has inflation reached our long-term goal? I don't think it has, right? We're somewhere north of 2. I'm going to call it average 2.5. If you go with the headline, it's still 3.2 or vice versa. It's not where we need it to be, but it's in the right range. Now, the one really interesting thing is how often was inflation actually at 2% looking back?
You want me to pull that chart back up? I got the chart right here, or we can
Yeah,
keep going.
no, the answer we know is that it's never there really, to be honest with you, for all intents and purposes, it's just not
Yeah.
there. So we're into the old close counts area right now, right?
Horseshoes and hand grenades, you got it.
Right
Yeah,
on. So inflation has been slowing. It's still above our long-term target. We can have some resistance going down. So we just got to really focus in on making sure that it doesn't reignite with lower rates. And that's one of the big issues that can happen, and we're watching. Unemployment. So that is an absolutely fascinating thing. The core, one of their mandates besides inflation is employment. And we are at such low, unusually low unemployment rates for such a long period of time. As we see this ramp up in unemployment, I think at 75 basis points it's come up, or almost 100 basis points
right.
it's come up, that's like, whoa, wow. Or it's kind of like delinquencies, right? They've come up tremendously, but they're still either below normal or normal. Unemployment is extremely important. And when we see the difference between who's employed, I talked about prime age workers. They are employed, they're doing work, they're working, they're making money. Um, Things have been going very well there. Now, we do have some other demographics that are not doing well in that world, right? Especially when you look at like delinquencies, not doing well is in the delinquency world. A lot of the younger demographics, high delinquency rates, right? Um, so unemployment's rising. We need to get to stabilizing that it goes sideways. We're going to 50 basis points down, another whatever it is for the rest of the year and next year is really going to stabilize that. I hope, though, what's concerning us is the employment cost index. I don't think we're covering that today in the chart, so I just want to mention here are my thoughts. It's very important because when we went through the whole COVID thing, the ECI, the Employment Cost Index, which is wages and benefits,
Right.
it skyrocketed. Right? It
Correct.
went way up along with the inflation for your milk and eggs and bread and all that. We've got to be really careful is if we reignite unemployment to come back down, our employment cost index is going to start skyrocketing and refueling inflation in that period. And we've got to be careful there. So I'm really worried about that and going to pay attention to it. Talked about our prime age stuff in the labor force participation and the LASAM rule. So we'll go past that. And then they'll get into housing.
Yeah.
It's an eternal problem, Charlie. How long has housing problem been a problem? Has it been 20-year problem so far? It's
Oh,
make up.
the problem, it was too low in value in 2010, 11, 12, and now we've flipped into too high. But no, it's interesting. You get down to all sorts of demographic things here that are unable to be controlled by fiscal policy and monetary policy. It's again, then you bring in, we can go down a whole path of talking about people coming across borders and immigration and what happens there, and that definitely threw a wrench in all this big time.
Yeah, absolutely. The housing market is one of the more extreme volatile markets, and our competition
Yeah.
for our customers demonstrates that. As we went through the Great Recession, we're calling it,
Right.
is, who went out of business more than anybody was the mortgage brokers, right?
Home builders and mortgage
Home
brokers.
builders and
Yeah.
mortgage brokers, the
Yeah.
banks, the credit unions. There's some closures, but not in any percentage numbers as those others. And it's, we just got to pay attention to that. We need to get some built, and we really need to support them to be in here right now, and to be ready. With these lower rate environments, our clients are going to they're already going crazy with respect to refis and purchases because rates are down 100 basis points, right?
Yeah.
So anyway, new home units, we need to build more. We need to try to figure out how to do them more affordable. I'm hoping that sector may translate into almost like prefab houses. It seems to be becoming more and more popular with houses being delivered and assembled as opposed to built on site. I think you were talking a little bit about what
3D printed homes and cement, baby.
3D home printing. Seems
Yep.
like a slow process, but it's, we need to reinvent how it's happening a little
Have
bit,
you
I
have
think.
you seen a plumber? It's not that slow.
No, I have not. Well,
All right.
plumbers and electricians make the world go round because when they're not there, everything stops.
Yep.
And then lastly, it's the consumer. You mentioned, consumer making up high 60s to 70% of the economy. That's a true statement, just depends on the day, but it's a huge percentage. And the real consumer spending, when you're doing inflation adjusted, it's continuing to increase. The problem is it's increasing with that credit card debt, and it's a major concern, a red flag, and why one of the reasons the Fed's lowering rates. And our delinquencies continue to rise. So we're really concerned about that. I'm hoping we don't get back to manufactured bankruptcies, right? People are just kind of walking away, turning in their keys. I don't get that feeling right now. But as we look at, and some of our clients have larger indirect programs for autos, those are ones that usually take a hit. And with the declining asset value that's collateralizing those portfolios, that consumer is going to be looking at, hey, what's the value of this car? And if how much do I owe? It might ignite a little bit in that world for that auto lending world.
Hey, it's a great transition there, because I have seen some clients telling us that they are seeing people go out and buy cheaper cars and dropping off their expensive new car that they can't afford the payments on. And so we're seeing a little bit of that happening. It's not a epidemic type level, or it's not getting there, but we are seeing some things. And I think your point is really good. The consumer is still spending, but we worry how much of that is based off of credit card spending and how sustainable is it. And so it does go into the fact that the Fed could be, raising or lowering rates at an appropriate time. Now, some of my thoughts, which are interesting, I feel the Fed almost painted themselves into a corner and had to do a rate cut. But if that was the case, they probably would have done 25. And so I think my original thoughts, and that's probably a bit off. I do think data dependency is extremely important. We do still continue to see, though, a growing economy. And so it's this dichotomy of the two economic environments. I don't think the data supported a rate cut yesterday, but the more and more I look at delinquency and credit card spending, I think the forward thinking aspect does support the rate cuts that took place. I do think the Fed is more fearful of a recession than seeing a recession today. And that's effectively what we want. If you want a central bank, you want that central bank to be thinking about the trend we're going to worry about where we might go to get us not to go there. So this might be a good part of forward-looking activities. Um, one of the things I was looking at too, which is really interesting, is if you look at history and when you see pivots take place, the Fed usually is late. They historically have been late to the game, and we're into a recession. They're cutting rates quickly. So history says that we may already be in a recession in some ways. I don't think we are, but that's usually when the Fed cuts rates, is when we're actually in a recession. So it's interesting to think about that.
Are you saying they're being they might be proactive and they might not. Hindsight will tell us.
Right. We'll know after the fact, which is, come on, Greenspan driving and looking in the rearview mirror. It's kind of fun.
I love that.
Uh, but I think, well, for me, one of the things that made this a very difficult conversation on should the Fed cut rates or what should they do, when I think about the cost of a home and house and inflation and rent and shelter, I almost wanted the Fed to raise rates to break the housing market so people could afford to buy houses again. That's a terrible thing to say. It hurts so many people. That's people's nest eggs and retirements. But I hate to see this younger generation really struggle to buy homes. And I do think your version, which is build more homes, is a heck of a lot better than my version, which is destroy the economy so people can buy homes. So it's the right way to do it. But I do think this really leads to the K-shaped economy. And so thinking about, your customers and members out there, we really have two different looking members today, or two different customers today. Those that are financially strong, and those that own houses. If you've owned a house for 5 years and you have a 3% or lower mortgage rate, you're feeling really good. Hey, my house is up 30, 40% in value. My payments are super low. Yeah, a couple other things cost more in life, but I'm still paying my small mortgage payment. And I tell you, those who own stocks and other investments have also done really, really well the past 5 years. People feel good. They're happy. And this, though, is this dichotomy, because if you don't own a house, if you've been renting, you've seen your rent price probably double in the past 5 years, and you haven't seen your income double in the past 5 years. So that's been greater than pay. And again, if you're a newly out of school and starting off life, food and insurance costs have skyrocketed. So it's making it very, very difficult for the newer kids out of school, getting into the workforce to really survive. And so I think here, as we look at lending, credit scores are important and all these things are important, but I almost want to look at, does someone have a house, they own a house, is at a low interest rate on that borrowing? That's really going to offset someone's financial capacity to survive and thrive in the next few years. Really, really different way of thinking about things. Well, taking that and going forward, Craig, one of the things I want to talk a little bit about is some practical things for everyone to take away from a webinar. I always want to have some good things to think about. Value. Lending is going to be interesting here. What do you see happening in the lending space here of the next year?
Well, it's going to continue to be extremely important on the credits that where people are underwriting. And I think history has proven that any kind of over concentration in any one industry can lead to disaster for an financial institution. So ultimately, I think that we've got to make sure that our clients are doing what they know, lending to what they know, and making sure they know their borrowers, do the proper due diligence, and actually are doing all the metrics on it, right?
Yep.
I do expect that, though, they got to really compensate when they're doing. I expect lending rates to come down a little bit, unfortunately. So talk about margins there is to make sure that they kind of forecast a little bit of an increase in their CECL reserves. That's going to be important to really think about when pricing those loans, because as we see the trends and we look at the different methodologies in the CECL world, it's going to cause them to have to reserve more. And so we
Right.
should probably make sure that we don't lower rates too much. And it's okay to, maybe lose a loan or two just because we want to make sure that our margins are there adequately.
I love that statement. One of the things in the MFA Navigator, we now have a loan pricing tool, and one of the options there is to modify your CECL number to raise it or lower it for pricing. And to think about that and think about if we have more delinquency, you have to increase that CECL number is really important. I do think the consumer here is definitely going to be waning in some ways and might see them pull back. So thinking about that and think about who you're lending to. If you're lending to a business, what is the business they're in, and just being careful on that. But I do think that stress is going to continue to be on the consumer, which is going to make lending more difficult. It's going to make volumes of lending a bit more difficult too. So I think your point though is really be careful with credit and really be careful with your CECL reserve. Extremely important. All right, moving to investing. I'm just going to start at the bottom and then throw it to you. It's probably being in cash is a bad idea right now.
It seems to be. Rates are
Yeah.
going where? Yeah.
They're definitely, the Fed told us they're going down, what, another 50 basis points this year, 100 basis points minimum next year, right?
Yes. So that the cash has been a pretty good gaming for a lot of people, right? And
Hmm.
it's going to be changing. And we are actually seeing a changing of the slope of the yield curve as well, where we do have the positive slope between twos and tens right now. Shorter than that, it's still, it's the rate cycle that's not uninverted between overnights and the 2 year, but the twos, tens are positively slope. And that's telling us a lot, actually.
Yeah.
But ultimately, we would expect that with the rates coming down with a positive slope, that we're going to see the curve come down a little bit more and the short end coming down more than the long end. And so we really got to look at as managing investment portfolios is paying attention to the duration of your portfolio and seeing where if you can put a little bit more duration on to get the lock in these better rates right now that are going to be diminishing, and make sure when doing that though that your balance sheet can handle that extra interest rate risk that you'd be putting on. So it's very paramount to be paying attention to that. But we do believe that it's important to be locking in some good investment yields and with longer duration without having that negative convexity, meaning that investment will stay with us, not be called away. So yeah, callables are the devil, right?
No, I 100% agree with you, which doesn't surprise anyone with my comments lately. But no,
Yeah.
it's a really good insight to give people. And one of the things we talk about why this is such a big meeting, the Fed meeting today, and Craig mentioned something extremely important. The 2 to 10 year is actually positive slope now. Just for the record, 793 days we were inverted, which is a record, the longest inversion on record in the United States. So big modification after 793 days. And I think it's a good indicator of what's coming as we go forward from here. So reduce cash, extend duration, keep moving forward. One of the things that does concern me is deposits, and I miswrote the acronym again. Shocking. Those that know me, my spelling and acronyms are entertaining. But we have definitely, I'm concerned a little bit about deposit costs not coming down as we go forward here for the next 6 months. Now, trust me, I want them to come down. But one of my concerns is all the bank term loan fund, the dollars that are going to be taken away. So people I know have borrowed a lot of money or have money set aside to pay those off. We've got to pay those borrowings off. There's a lot of short-term CDs people have done, brokered CDs coming due. I'm definitely concerned about this, and I think this is going to continue to be a challenge, which is going to make our margins potentially tighter because our loan yields and investment yields may come down a little bit, and our cost of funds may not come down very much. But the one positive I'll throw out there, the amount of money in money market funds is an astronomical right now. And we talk about the Goldman Sachs money market fund, which was paying 5.2 or 5.3% 2 days ago, which is now well below that. There's a lot of money that may come back into the system, which could really make my concerns not come to light. Any thoughts on that, Craig?
Yeah, a couple. You've mentioned some really good points there. I'll leave the acronym alone, and kind of go towards. There was a lot of people running specials, and those are rolling off. And current market rates, just to grab the money, even hot money, is 100 basis points lower than what's rolling off of all those specials. So naturally, we're going to see some repricing that's going to bring down cost of funds to help offset some of the variable rate loan repricing that's going on and existing new loan production. So that is great. And I think that when looking with your rate setting committees, we're in especially in a falling rate environment, actually all the time, but really in a rate and falling environment, you need to ramp up your time that you spend and frequency of meeting with your rate setting committees because it's going to be dynamic. Of course, you have your competition that drives what availability, liquidity is available to you, but you really got to make sure we're slowly but surely ratcheting down these things. Your comment on the money market funds, I really like because money market funds by law have to stay within a short period of time of securities.
Right.
Within 12 months, everything will be matured off in those funds completely and repriced in current market rates. So that competition will be dwindling very quickly.
Yeah.
And then one thing is, with the federal governments, the bank term funding program, as well as say some wholesale stuff of broker deposit with the home loan bank or what, that's all going to roll off and we're going to be rolling down the curve. But don't be too worried about what the competition is doing right now. In a falling rate environment, your consumers aren't going to be grabbing at long term who's got the best CD market in the market. Remember, when we were in that low rate environment for a long period of time, nobody had CDs. Our young people coming out of college and young workforce, they didn't even know what a CD was, right? It's just all savings account. As we go through this rate cycle of lower rates, we'll see that migration back from CDs into non-maturity deposits. So I like the idea of rolling down or reducing those rates on non-maturity bots a little bit. I don't think it'll be as much of a concern to be losing deposits. No, hopefully I'm right, and we won't have as much pressure, uh, but or we won't have a lot of pressure, but who knows? We'll see. But I like the idea of slowly ratcheting down deposits.
Yep. I think that's a great way of thinking about it, and a lot of things will have to change. Well, I want to get through a couple more things here and wrap up, and then we'll do a couple questions at the end that have come in. What's going to happen next? Talking about projections, what are they going to do? And we've said data dependent. You've heard that a bunch of times from us, but they did also tell us they are lowering rates. The Fed made it perfectly clear that they want to lower rates another 50 basis points this year and 100 basis points the following year. It was a pretty bold statement for them to say that. The dot plot here, your favorite thing in the world, my viewpoint that the board of directors doesn't agree to anything, apparently, the Federal Reserve Board. They're all over the place. I see here in 2025, we're as high as 4%, we're as low as 275. And we get even worse out in 2027. We go from 4 to 225. So they're all over the board here, but definitely they are consistent, though, that the Fed will be on a path of lowering interest rates. What should the real rate of return be on Fed funds compared to inflation, Craig? Where would you put that here?
Well, me personally, I love all of our clients and the consumer, so it should be as high as possible. But with our clients, typically long-term range has been around 100 to 150 basis points, and I think long-term average is around that 150 basis points. So with inflation hovering around 2.5, we're talking overnight rates going to be right around that 4% is where it kind of should be based on real rate of returns if you use that 150.
Yeah. So that does mean the Fed does need to continue. And I think that was a bit of their point. And, looking at the projected Fed funds rate next, it's definitely showing some pretty big cuts here.
Yeah. I like to look at the implied rate column, far right-hand column or second from the right column. It says implied rate there. And if this is what the financial markets are placing bets on to where the Fed funds future or the overnight lending rate will be in the future. And if you look out, say, just 1 year from now, say September or October, it's just under 3%, right? If you round it, it'd
Right.
be 3%. So that's 200 basis points lower than we're at right now at 5 to 5.25. So there's a lot of expectation for rates to be going out or to going down.
Yep.
Um, and of course it is, like you said, it's data dependent. It's always been data dependent. It's just a matter of the Fed reminding the markets that, hey, we're not going to get bullied in. We're apolitical. It's all data dependent on what we're doing. And so I don't know if this will come to fruition. We're going to see what happens with inflation, which we're concerned about getting reignited.
Yeah, the Fed funds futures here are never correct, but they're always usually the right direction. And this is saying somewhere around 275 to 3% at the end of next year. So definitely some quick reductions taking place really fast.
Yeah.
So with that, the wrap up here with our projections, we do expect here in November and December some rate cuts. Is it going to be 25 each or 50? They did say 50, so I don't think I'm letting the cat out of the bag, right?
No, not at all. Yeah. It's a good solid bet.
Yeah, good solid bet. And then looking at the first half of next year, do you think that we're going to have a rate cut in the first half of next year or throughout the year? What are your thoughts for 2025?
It's data dependent, you know.
I love it. I love it.
I
Yeah,
do think they'll have a continued lowering because just remember when you lower rates, when do you understand what actually happens and the impact of that rate? It's not for quite some time after it, right? Nine
yep,
18 months later. So that's where it's really careful, of overshooting the lowering of interest rates. I do think they'll probably continue to lower in 25 until they see that inflation starting to pick up and unemployment gets too hot. So yeah,
yeah.
100 is very reasonable for 2025 right now.
I think as we try to engineer a soft landing, you've really got to look at those pieces and make sure you understand what happens. So with that, I think to wrap up the projections here, we're into some questions. We do see the Fed continuing to lower rates, probably 50 basis points this year, very data dependent. And they did say 100 basis points next year. Again, very forward-looking statement by the Fed, which I found very unique, the way they said it. But they are trying to message to the market that they're going to try to engineer a soft landing and not have a financial crisis on their hands. I still think they're a little maybe egg in their face from the last time around where they raised too much and really broke the housing market, and they're trying to learn from that now. So with that, we do have some questions. The Q&A button is there. Please feel free to click it. I know we're running a little low on time, but two quick questions here. I'm going to take one and throw the other one to Craig. The first one is going to be easy that we'll take is a watcher here said that many student loans go into repayment on October 1st of 2024. How do you see this affecting the economy? I tell you, I don't think I've seen a worse done thing by our federal government than how they've been handling student loans for the past 3 years. People don't know who their servicers are. People don't know if they're supposed to make payments or not. Are they forgiven, not forgiven? It's an absolute mess. And more what we're seeing, read a great data point, something around 80% of borrowers are paying less than $10 a month right now just to make a payment. So I don't think it's going to have much an effect. I do know there's a number of court cases, Supreme Court cases outstanding. But if it does go into effect and all the forgivenesses get reversed, that will definitely slow the economy. So we'll have to keep a close eye on it, but I don't expect much to happen there. And then real quick, Craig, we have time for a short answer. Do you recommend borrowing money to purchase investments today?
That's a absolutely fantastic question because every now and again we do get the opportunity to actually do a riskless leverage like that, and I call it a riskless leverage. And what riskless means, though, is credit, right? If you're investing something, are you going to be putting on credit to create that spread between your borrowing? And the other one is, duration. So I wouldn't recommend doing, say, a mismatch of your durations. But if you have capital implications that can be overcome, meaning you've got a lot of capital laying around in your desk drawers, you could do it, right? If you can do a duration match without doing credit risk, it's not a terrible problem. But I don't really like the idea of playing the game of doing a duration mismatch of, borrowing short because rates are going down, investing long, because then it's like, are you wrong? You know,
Right.
Yeah, it's not what we're in the business of and doing right now.
Yeah. So it can be done if done correctly. Be very careful with optionality. Also, we've seen years ago people get really hurt when they don't understand the optionality they're utilizing for this. So with that, I do want to thank everyone. A great last second question came in. Where do we see mortgage rates? We expect this will be more of a parallel shift now that we have the normal sloped yield curve. So we'd expect mortgage rates to continue to come down some, maybe not the full amount. Craig, do you agree with that statement?
Yeah, I do expect by the end of 25 to have actually a steeper yield curve than we have right now. So mortgage rates may not come down quite as much as our
Yeah.
deposit costs, which is great for all of us, right?
Yeah.
On the call, hopefully it'll help insulate us from having margin compression during this cycle decrease.
Well, Craig, thank you very much. I apologize, guys. We're a minute over. I try to keep these on track so everyone books meetings on the hour. Coming up next, we do have next week on September 25th, EBPA, Employee Benefit Pre-Funding Account and Charitable Donation Accounts, our 201 webinar. The second in our 101, 201, 301 series. Really excited about that. Please sign up and join us. Love to have that. Craig and I believe Zach Whaley will be running that presentation. So super excited to have our two experts on that. And again, Craig, thank you very much for your time and your expertise today. Really appreciate the time.
Yep, you're welcome. Thank you. Everybody have a great day and thank you for joining us.
Thanks, guys. Have a wonderful day, everyone.